Welcome to another episode of Healthy, Wealthy, and Wise Retirement Podcast, where certified financial planner Lauren Sherman shares thoughts on having a healthy mind, body, and spirit, an abundance of wealth inside portfolios and out, and lessons learned from clients and mentors over the years.
Welcome back, and thanks for joining me for this week's episode titled Timing the Market. As I like to do, let's start off with a quick story about our friend Kellen. Kellen is a well-educated man. He had a great career where he was promoted often and made a good living in the process. During his working years, Kellen did not have to make many decisions when it came to his investments, as the majority of it was automated through his company's retirement plan. That changed for Kellen when he retired a little over 20 years ago. Like most people, Kellen transferred his 401k into an individual retirement account when he left his job. At that time, the decisions of how to invest were now in his hands. Kellen immediately moved to a conservative portfolio. His thinking was that he was no longer working, so he couldn't make up for big losses anymore. In the back of his mind were also the stories he remembers his parents telling him about how awful the Great Depression was. Jobs were in short supply, one can of soup had to feed 5 kids, and every resource had to be stretched and reused to make ends meet. It's hard to fault Kellen, as it looked like he was simply doing the responsible thing for his family. Even with a conservative approach, shortly into retirement, Kellen's portfolio took a hit due to the dot-com crash. Internet companies were booming in the 90s, but all of that came to a halt. Kellen didn't like seeing his portfolio go backwards, so he moved about half of it into cash. He figured there would be a good time to get back into the market once the dust had cleared and it was safe again. Not long after, September 11th happened, and in 2001, our country was under attack. The stock market responded with another steep decline, and Kellen made the decision to move the rest of his portfolio into cash, as at least he wouldn't see it keep losing money. Years would go by, and the news media and financial headlines never seemed overly optimistic, so Kellen would only slowly move some of his cash back into the market. Then 2008 happened with the financial crisis, and we saw one of the steepest declines in the stock market that we had ever experienced. On top of this, companies were getting bailed out left and right, but the everyday investor had to absorb their losses. This frustration was enough for Kellen to move back into cash until there was a better time to invest. Of course, since then, the U.S. government credit rating was downgraded in 2011. We've been in a seemingly endless war overseas. We've seen home prices fluctuate dramatically, supply chain issues, and then in 2020, another big market pullback with the emergence of COVID shutting down much of the world. Today, there's political strife as our politicians spend money almost as fast as they can print it. We have uncertainty with Ukraine and Russia, and nobody is sure where inflation will be a year from now. With all that's happened in the past 20 years, and all of this going on right now, Kellen gives himself a pat on the back for staying out of this mess and keeping his retirement safe in cash. It's tough to blame Kellen for any of the choices he made, as this world has given us plenty to be weary of, and the stock market hasn't been the smoothest of rides. However, since Kellen's retirement in 1999, the stock market, represented by the S&P 500 for our purposes today, rose roughly 383%. That's over 7% per year, or close to 5% if you adjust for inflation. Remember, that includes all of these horrible events that have taken place in the last 20 years. Through every doom and gloom headline and every negative news cycle, the market has still done what it nearly always does when given enough time. While Kellen felt like he was doing the responsible thing, his investments held in cash earned him very little interest over the last 20 years. Because of this, he and his family have lived on a tight budget with little to spare throughout their retirement. Unfortunately, this is more than just a story, as I have witnessed this exact situation and many similar more times than I can count. While stories can be helpful, some of you listening are waiting to hear the details. So let's move into 6 reasons why timing the market does not work out. Then we will finish up by giving you a better alternative and some strategies you can use on your own. So we will end on a high note, but first, Let's dive into reason number 1 that market timing, as I call it, is a losing strategy. Number 1, market timing reduces your overall return. It's impossible to say just how much market timing reduces your return by, as everyone has a different approach and different emotions that drive their decisions. But what experts overwhelmingly agree on is that this is a losing strategy over any substantial period of time. The challenge here is that even when we are hurting our returns, it's often hard to tell since we're too close to the situation. It's going to be difficult to compare our actual return with the return we would have gotten without market timing. Overconfidence and confirmation bias come into play as well. A couple of quote-unquote correct decisions give us confidence that may not be well earned, and our brain tends to remember these correct decisions as skillful, while our incorrect decisions get categorized as simply unlucky breaks. And it's easy to be overconfident and deceive ourselves a bit as markets generally go up. You could spend a year's worth of trading in and out of accounts and think you had an excellent year with a return of 8%. All in all, the benchmark you should be comparing your performance to may have done 10% in that same year. But without that information, you think you did a great job with 8%, and your confidence is even more bloated, so the trend often continues. There are some very interesting books on this topic if you would like to get into the weeds, and I will link a couple of them that I've read a few years back, but I want to warn you ahead of time, they are incredibly well researched and have great info, but they do get pretty technical, so perhaps the Cliff Notes would be a better recommendation. Setting aside our own biases, what does this look like in reality? Well, one study researching quantitative analysis of investor behavior found that over a 10-year period where the market returned almost 7% per year, the return the investors managing their own portfolio was nearly half that at just 3.64%. I'm going to say that one more time just so it's clear. During the 10-year period of their research, the market had an annualized return of almost 7%, while the investor managing their own portfolio almost cut that in half at 3.64%. The same held true over different time periods, whether it was just 1 year, 5, 10, or even 30 years. In fact, in this particular study, the annual return during their 30-year time frame was just over 10%, while the investor managing their own portfolio only was able to show a return of about 4%. Percentages can be tough to wrap our heads around, as the difference between 4 and 10 is a fair amount, but it doesn't sound like that wide of a gap. But if we start with just $100,000 and plug the numbers in, we find that over a 30-year time frame, our $100,000 would have grown to about $324,000. Not bad at all. When we do the exact same with our $100,000 and manage to get the full return of the market at 10% for 30 years, this portfolio ends up with a whopping $1.7 million. Sometimes it's easy to hear all of this and just point the finger at others, thinking, I would never do that. But think for a moment. Have you ever altered your investments based on what you think might be coming in the future? Have you ever considered it or been tempted to? What about when it seems like everyone around you is excited to tell you about their stock that's taking off? It's only natural to question your decisions in these moments, because even when we understand the math, we can feel left out of the party. Perhaps on the other side of the coin, you're watching your portfolio decline and hearing all the doom and gloom news. It's easy to tell yourself, well, this time is different. Maybe you aren't fully convinced and still think you or your advisor can time the market better than others. There's plenty of research that contradicts this, but even if you were somehow right, how much would it benefit you to time it correctly each year? You might be surprised, but even with perfect timing, you're not actually adding all that much to your portfolio. As the Schwab Center for Financial Research found in their study, time in the market is far more important than timing the market. For more on this study, check out the show notes to see how our investor called Perfect Peter barely outperformed our other investors, even though he invested on exactly the lowest market day of the year for 20 straight years. Obviously, no one could ever time the market this perfectly, but it's eye-opening to see that even with perfect timing, you're not gaining much of an edge. I started off with our longest reason, so I will zip through these next few. Moving on to reason number 2 why timing the market is a losing strategy. It comes with plenty of anxiety and unnecessary headaches. I don't know about you, but most of the people I talk with put in the hard work so that they could enjoy the fruits of their labor in retirement. It's hard to enjoy the vacations, the grandkids' ball games, or simply the lazy days around the house if the stock market is always on your mind. I suppose one could argue that the headaches are worth it if it means for better performance. But as we just covered a minute ago, all of the stress and anxiety of market timing only comes with reduced performance. During an actual crisis or a perceived crisis, the toughest thing to do is nothing, but often that's the best action we can take. And if doing nothing isn't your thing, then follow the advice of retired U.S. Navy SEAL Jocko Willink. In his book, Discipline Equals Freedom, Jocko says, "Use the stress to make you a better you." He goes on to explain, "Don't fight stress, embrace it, turn it on itself. Use it to make yourself sharper and more alert. Use it to make you think and learn and get better and smarter and more effective." What Jocko is saying is that we can use stress to our advantage if we direct it into something productive. Relating back to markets, what is not productive is trading in and out of the market just because our stress level is high. Reason number 3, market timing is expensive. If you are doing any sort of market timing, you are going to be doing far more trading than is needed. Whether this means absorbing the bid-ask spread, paying a trading commission, or a custodial fee, all of this adds up, especially when you look at years' worth of trades and compound this over time. Sure, a lot of these costs have come down quite a bit over the years, but once again, going back to our first point, there's no added value you are getting in return for paying these unnecessary fees. One other way that market timing can become expensive is if you do this within a taxable account. You can create a lot of short-term gains or losses that are not treated as favorably as long-term. So you could be triggering taxes that erode your performance. Reason number 4, investors who market time are rarely aligned properly with their risk tolerance or their risk capacity. One quick note on this, I will be recording an entire episode focused on finding your portfolio's proper risk number. But to give you the 10,000-foot view of these terms, risk tolerance, also referred to as risk preference, is simply how comfortable you are with risk. Risk capacity, on the other hand, more closely reflects your portfolio's ideal risk if we were to get rid of any emotional considerations and view your portfolio strictly from an analytical standpoint. Back to market timing. If this is your strategy, you're going to be in and out of the market quite a bit, and this means that at certain points in time, you will have very little market risk, while other times, when you get back into the market, there's a good chance you end up more aggressive than your risk tolerance or your risk capacity would actually recommend. Even though the market itself can be a little bit like a roller coaster, that doesn't mean the amount of risk we take on should be up and down in the same way. Moving into reason number 5, a disproportionate amount of the market's gains happen within only a handful of days. This also relates back to our first reason that we covered, in that market timing simply reduces your overall return. But the reality that a lot of market timers don't think about is that not only do they have to be correct once, but they have to be correct twice. Just like Kellen in our story at the beginning of the show, many people become fearful and take money out of the market, but they have no plan for part 2, when to put it back in. Looking back upon roughly the past 15 years, the market returned an annualized rate of a little over 10.5%. And once again, when I say generically the market, I'm referring to the S&P 500 index unless otherwise mentioned. So we're feeling great at over 10.5%, but what if we got a little greedy or perhaps a little fearful and we tried to time the market swings during this same time frame? Well, if we would have missed just the 10 best days of market gains, our return drops to about 5%. So during a 15-year span, We got into the market just a little too late and missed these 10 days, and over half of our growth is gone just like that. If we missed the 20 best days during this same 15-year period, now we might as well have kept our money in cash and avoided the headaches because we only saw a return of 1.59%. And finally, if we missed the best 30 days during the same 15-year time frame, we actually lost close to 1.2%. The problem that this data reflects is that market trends only look obvious when we have the power of hindsight. I promise you, it's as clear as mud while you are experiencing these market fluctuations in the moment. Additionally, the market always turns before the news cycle or the prognosticators tell you. So market timers often come in late to the party after we've seen these amazing days in the market that we were just talking about. In fact, we recommend that clients avoid market commentary altogether. So if this is you and you feel like you aren't being a good steward of your money if you are not reading the articles and watching the market-related news, I give you full permission to turn it off for good. This doesn't make you a bad investor, and it doesn't make you uninformed. Personally, I think there's a strong argument that could be made for cutting back on news of any kind, but that's a rabbit hole I won't go down, so we will leave it at that. And the sixth and final downside to market timing that we will cover on today's episode is simply the loss of your time. Perhaps more importantly than all of the other reasons we talked about earlier, market timing draws you in to a world of spreadsheets, pie charts, and talking heads on TV with an air horn and a megaphone. All of this is pulling you away from your goals and your purpose. As an advisor, it's easy to get drawn into this world too, but we have to remember that money is just a means to an end. It represents freedom. It represents the ability to accomplish your goals. And if you have enough of it, money allows you to check off a lot more on your retirement bucket list if you happen to have created such a list. Money allows you to help others in need, help your grandkids buy their first home, and support your local businesses and charities. We believe this is a much better use of time, as your retirement hours shouldn't be spent looking for market timing opportunities, but instead with the people and hobbies you enjoy most. So that's our list of 6 reasons why market timing is a losing strategy. To quickly run through them again, first, it's a losing strategy that subtracts rather than adds to your portfolio. Second, the strategy comes with plenty of anxiety and unnecessary headaches, something none of us need, especially in our retirement years. Third, market timing is much more expensive than the alternative. Fourth, the strategy throws your risk profile out of whack. Fifth, much of the market's gain for the year occurs within only a handful of days. This makes them easy to miss if you're timing the market, which spells disaster for your long-term performance. And sixth, a market timing strategy consumes a lot of your time. We tend to believe that retirees have more important things to focus on. Now, I've hinted at some of the solutions we can look at instead of market timing, but what if we think about Kellen from the beginning of this episode? What would he do differently if he could do it all over again? Well, first off, if you are younger, you can take advantage of dollar cost averaging by investing consistently each month. This is what many investors do without thinking about it, as most retirement plans allow for automated contributions. If instead you are retired and you are taking money out of your portfolio as income, rather than putting it in, one action you can take is to adjust your spending based on guardrails. Guardrails refer to different thresholds your portfolio may hit. Either it's outperforming expectations and you can take a raise, or it's underperforming and a pay cut is in order. Rather than discuss this in more detail, you can check out my episode on retirement income strategies with a full explanation. I will link that in the show notes as well. To take a step back, before we can put guardrails in place, it's important to establish clear goals. When we have an idea what we want retirement to look like, we can start to think of your assets in terms of the time frame in which you will need them. Sometimes the visual of having different buckets to illustrate each time frame can be helpful. For example, you have your short-term bucket that you plan to spend within the next 5 years. You have a mid-term bucket that you will use for the next 10 years after that. And you have a longer-term bucket that you likely won't dip into for another 15 years from now. And you don't necessarily have to invest your assets any differently for this, As for many, simply thinking of your retirement funds in this way is helpful. We touched on this earlier, but it's worth repeating. Get clear on your risk preference as well as your risk capacity so that you can align your portfolio accordingly. In line with this idea, we don't want to simply start our portfolio so it's aligned with our risk profile. We want to keep it aligned as well. So with that, we will need to rebalance when our portfolio gets out of whack. You can think of rebalancing in terms of a simple pie chart. If we have 60% stocks and 40% bonds, but our stocks keep outperforming our bonds, there's nothing wrong with that, and it's to be expected over time. But this means our pie chart could morph into 80% stocks and 20% bonds if it goes unchecked. Now, all of a sudden, we are invested much more aggressively than you would like to be. By rebalancing back to our 60-40 split, we can keep our risk profile consistent. Let's continue this thought of a stocks and bonds pie chart with our final solution. Traditionally, investors have thought of stocks and bonds as a well-diversified portfolio, kind of like a teeter-totter. One goes up, the other goes down. But as people have found out when they check their statements and they see that both stocks and bonds are in the red, the two do not always move in opposite directions of each other. This is why we've always recommended that you need to expand your pie chart to include alternatives. Alternative investments may have a negative correlation to the market, meaning they go up when the market goes down. They may have no correlation, or at least very low correlation, which means its return is completely unrelated to market movements. Or it may have a fixed rate or some sort of market protection so that it does not lose money when the market drops. This is a very broad explanation, but in general, a portfolio made up of stocks, bonds, and alternatives is going to offer better diversification and more protection during any market environment. So to recap, market timing is not the solution, and instead, a better use of our time is to get clear on our goals so that we have a general idea of the time frame each asset will be needed. We can also learn our risk preference and capacity and align our portfolio accordingly. Next, we have a system to rebalance. We add alternatives to our pie chart, and we can set up our guardrails in case things don't go according to plan and we need to make some adjustments. The technical term you may hear a financial planner use for all of this information is your investment policy statement. So it's possible that you've heard that term before, but now you know behind the scenes what goes into it. I will leave you with a quote from Peter Lynch, who was a successful mutual fund manager in the late 70s and 80s, and he has remained an integral part of the investment research community to this day. His advice still resonates, as Peter claimed, "Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves." And for anyone a little confused by that quote, the term corrections is just a polite way of describing a steep market drop. So what he's saying is that far more people lose out on great market returns preparing for market drops than they do from actual market drops. Hopefully that makes sense, but if you'd like feedback specific to you and your retirement planning, feel free to take the first step by completing that quick 2-minute assessment that is linked in our show notes. And as always, you can find past episodes at healthywealthywiseretirement.com. Be well, and we will talk again in 2 weeks.
Thank you so much for listening and supporting this podcast. If you've enjoyed listening, we would love if you took a quick moment to leave an honest review. Of course, we're shooting for 5 stars, but if you have suggestions to improve the show, we would love to hear from you too. Just click on the podcast name, Healthy, Wealthy, and Wise Retirement Podcast, and scroll down to ratings and review. Thanks again for your support, as this helps us reach a wider audience and help even more retirees just like you. This podcast is for entertainment and informational purposes only and is not intended as a specific tax, legal, or investment advice. Lauren Sherman is a certified financial planner and co-owner of Integrity Wealth Management, an investment advisor serving retirees in search of their own healthy, wealthy, and wise retirement lifestyle.